So this could be the perfect opportunity for you to start your real estate investment portfolio with the help of the federal government, even if you have student loan debt. Okay, you're really going to want to watch this video. I've got some great news for you today. We're going to talk about how a recent rule change at the federal level is going to make it easier for you to purchase a home of your own, and it's actually going to make it easier for you to purchase investment real estate, okay, that you can actually derive income from. So let's go ahead and we're going to jump into that in just a moment. I just want to encourage you, if you find this content valuable, which today's content is going to be very valuable, I mean, monetarily speaking. If you find this content valuable and what we're doing here, you believe in the mission of us trying to, push people toward financial independence by opening up all of this news about different policy changes, what goes on in politics, how it affects your personal economy and the overall economy, go ahead and hit subscribe and hit like and help us share this message by hitting share and sharing it with a friend who might benefit as well. Friend or business partner. Hopefully your business partner is your friend. All right, let's get into it. The FHA recently changed a rule that calculates student loan debt differently in terms of how it relates to a mortgage. So if you've got student loan debt and it has been preventing you from getting an FHA mortgage, then this is going to be music to your ears. So I'm going to link to everything that we talk about here today. We're going to start off with this article that kind of breaks it down at a 30,000 foot level. How to qualify for an FHA mortgage even with student loan debt. HUD, the Housing and Urban Development Department, the federal department, has removed a requirement that calculated a borrower's monthly student loan payment as 1% of their outstanding student loan balance. Okay, so just picture it. You're going to hear this again in this video. $200,000. Let's just play with that number. You've got $200,000 worth of student loan debt. So the way the FHA was calculating that was saying we're going to, for the purposes of debt to income ratios, which we will cover in a minute, 1% is the number. So 1% of $200,000 is $2,000. So that's how it looked in your debt to income ratio. Now, in other words, despite being approved for a smaller monthly payment, borrowers were judged based on 1% of their outstanding loan balance, which is often a much higher number. So people were going in, they were negotiating with their student loan servicers and saying, hey, I need a lower payment. And in most cases, in many cases, they were getting that lower payment. But it was still being calculated in their debt to income ratio as 1% of whatever the loan balance was. So although they had a different payment, a smaller payment, everyone from the standpoint of lending the money still saw the higher payment in terms of the requirements that they had to go by. So let's use an example to illustrate this further. Dietrich Selvage is among those harmed by the way his student loan debt is calculated. With more than $200,000 in student debt, Mr. Selvage said he was disqualified for an FHA loan because the program assumed he pays about $2,000 a month in student loan debt repayments, far more than what he negotiated, which is $370 a month. So this man is paying less than $400 per month on his student loan debt. But because of the way the government told these mortgage service providers to calculate that debt, he's getting hit with $2,000 in his debt to income ratio. And it's screwing up that whole calculation and putting him way out beyond the minimum or the maximum debt to income ratio, which we'll talk about in a minute. So I think this is only fair. It reflects the reality of the situation. If you're not paying $2,000, that's actually not coming out of your pocket, why should you be assessed that on your debt to income ratio? You shouldn't. So this is an example of a regulatory agency, HUD, in the FHA, getting it right. So with the change, your monthly debt calculation will now be based on what you actually pay. This is important because qualifying for an FHA loan depends on your debt to income ratio, your monthly debt to income ratio. This is your monthly expenses in comparison to your income. So you divide by your pre-tax monthly income, and you divide those debts into that, and you get the DTI. Now, what they're looking for to qualify for an FHA loan is 43% or less. So they want to see you spending 43% or less on your debt service on a monthly basis. If you exceed that 43%, you're not going to qualify for that FHA loan. And your credit score also needs to be decent. Now, the FHA does not require a stellar credit score, but in this article, it says that you can have a poor credit score. We'll get to that and talk about that in a minute. I disagree with that. In many cases, the DTI rules are too prohibitive for borrowers with steady income and who consistently pay off their loans. For example, if you earn $4,000 a month and spend $1,370 a month on loans, that would be a debt to income ratio of 34%. However, under the old rules, 1% on a $200,000 debt would be counted as $2,000 per month on student debt. And that would increase your debt to income ratio to 75%. So even though you're not doing that, your debt to income, even though that's not your payment, your debt to income ratio was being raised up to reflect the 1% of your outstanding balance. And if you had a 75% debt to income ratio, you wouldn't qualify for the FHA loan. Now, the FHA mortgage is designed for low to middle income families and individuals, and as such, you can qualify with a poor credit score. Now, they say poor. I'm going to take issue with that because poor is a very relative term, and I don't want someone out there with a 400 credit score believing that Tyrone told them that they could get an FHA mortgage. So you need to, first of all, check with your mortgage service provider to get an exact range of what they're looking for credit-wise. But this author, this is a good article, but that one word, poor, it's too subjective. They should have included that in there. So check with your mortgage service provider in order to figure out what they're looking for in terms of a credit score. And your down payment can be low as 3.5%. Now, this is where it gets interesting because up until now, we've been talking about this in the context of you going out and purchasing a home to live in. At least that's, kind of the vibe we've had on this discussion so far. You're going to see this. The FHA loan is available on properties from 1 to 4 units. Now, 1 unit would be, of course, your single family home or your townhome you're living in there, and you got that FHA loan, and you were able to get into that house with a moderate credit score. You were able to get in for a 3.5% down payment. They took into account your new DTI with this rules change, and everything's fine. Everything's great. But did you also know that you can get a property between 1 and 4 units? So if you're living in 1 unit and you've got a duplex, you can rent the other unit out. The same is true if you got the 3 unit or the 4 unit. If you got a 4 unit, which you could get under these FHA guidelines, if you've got a 4 unit, you can occupy 1 unit, and then you could rent the other 3 units out. And so you could be in there gaining equity as the property appreciates. You got in at 3.5%, incredible leverage, and you could derive income from the other units that you're obviously only able to live in 1 at a time. You see how that works? So this could be the perfect opportunity for you to start your real estate investment portfolio with the help of the federal government, even if you have student loan debt. Now, I know the question you're probably asking yourself is, what is the maximum amount of loan you can get from the FHA? Well, that varies because they're looking at an entire country. So values are going to fluctuate all across the fruited plain. As we always say, real estate is a hyper-local market. We talked about that woman who's paying $2,000 for a 2-unit in Crenshaw, and that's rent controlled. In that other video we did the other day, and we've got folk in Baltimore City where the average rent is $1,500 per month. So totally different as you move throughout your city or your county, let alone the entire nation. So the FHA does have some guidelines per area, and I will include a link so you can check it out for yourself, and you can type in the information that is pertinent to where you live or where you want to live and see what their maximum amount loan limit is. All right, I hope you found this very helpful. This is powerful. This is a way that you can go out there and use leverage, use the government as a partner, okay, in this FHA loan. And now the student loan debt piece reflects the reality of what you're actually paying. All right, guys, I'll talk to you soon.